Welcome to Gold Silver Pros.
Hey everybody, this is Rob Keens with Gold Silver Pros. How are you guys doing today? It is Tuesday, December 19th, 2023, about a week before Christmas, a little bit less than a week before Christmas. Hope you guys are excited and ready as I am. I love this time of year. We have got an absolute lot to get through today. I'm going to do a traditional weekly market wrap up. A lot of you guys will be happy about that because it's very newsy and kind of keeps you up to date with what's going on in the world and specifically what's going on with gold and silver. We're going to do a little bit deeper analysis on gold and silver today. And we're also going to do a bunch of stories. Not much economic data to write home about other than the fact that manufacturing seems to be crashing pretty much across the U.S., although service economy, which is the bigger portion of the economy between the two, is holding up. Manufacturing is absolutely crashing right now, which is not good for the overall current account balance and what we're exporting. And it means we're going to have larger deficits. And you would think with the dollar falling a bit, that would make our products more attractive. But I think it just has to do with worldwide demand. The world is in a deep recession right now. And regardless of what the world leaders say and the numbers that they print, and it's clear that the U.S., outside of energy is really not manufacturing much of anything right now. What's holding up the economy is services. We're going to get into the consumer side and a lot of other stuff. I'm going to tell it in charts today. We're going to put a bunch of charts up today. A lot of stuff off of Twitter that I think you guys will find interesting instead of me just talking about the boring data. And then we'll do the deep dive into the precious metals right after that. So without further ado, we are going to get right into the numbers. This is a chart I put out yesterday that I grabbed from NerdWallet. And this is comparing CPI and rent CPI. So the Consumer Price Index, which is the government's indicator of inflation. I think it's Balderdash. I'd rather use ShadowStats or go to shadowstats.com. John Williams over there, wonderful economist. But everybody reports a CPI, so I'm going to throw a CPI chart out here. And that's the green line. The blue line is rent. So rent has been the single biggest driver of inflation in CPI since the pandemic. It's 29.4% across the U.S. And I can tell you in Texas, rent has absolutely exploded. A lot of it has to do with immigration, as I note here on my Twitter post over here on the right. Immigration is just going to drive this up. But the rent cost is going up so high, and there aren't enough units. So not only are there not enough rental units available, there are not enough affordable rental units available. And this is really impacting the consumer. That's why we're in retail capitulation right now. We're not quite retail carnage, but it's capitulation. It's a slowing down of retail spend. And retail's like, I got to spend on rent and energy and food. So even though you see some of the things going on positively with regards to CPI, the rent is a big. So the problem with this is, with rents rising as fast as they are, is it leads to other problems in the economy, which is what I'm going to go over next. People are being stressed right now, and because rent has gone up so much, and we have so many renters, as a percentage of their budget, they can't afford other things. And that's why retail sales are starting to come down. That's why the overuse of credit cards and those types of things. And then we move on to student loans. You guys will remember about 2 to 3 months ago, I talked about the big over $1 trillion in student loan debt. I think it's $1.5 trillion in student loan debt that was coming due. Something like 70% of people said they either could not pay it, or to pay the student loans, they had to give up a bunch of other stuff and maybe not pay their auto loans, not pay these other loans. Well, with that student loan issue and the rent issue, millions are having to make a choice of, do I live in an apartment? Do I have a place to live, or do I go homeless and pay my student loans? And here from the New York Times, we can see after the freeze was lifted on the student loans, 22 million people received their first bill, and around 60% paid, and the other 40 didn't. So if you remember our talking about student loans before, 34% said they couldn't pay them at all. Another 37% said we'll have to forego other things. And so those numbers are working out now. Exactly what we said before is working out now. Thanks to James Anderson for posting this, but this does not surprise me at all. We talked about this a couple of months ago. This is exactly what was going to happen. And the numbers are working out exactly as the studies predicted. I think it was Morgan Stanley and the Consumer Financial Protection Bureau talked about that student loan issue. And what do you know? Exactly what was said would happen a few months ago is happening right now. What about Credit conditions. Credit conditions deteriorate ahead of recessions. You can see right now that the overall credit conditions, according to Longview Economics and Macrobond, are starting to crash down. You can see this chart from the pandemic. When a lot of this started, credit conditions have been tightening and they're deteriorating, and it's another predictor of the recession. The next 3 months, expected credit conditions are expected to get much worse. And that's not a good thing, because when those tighten, it's even harder for people to make ends meet. Because you can't borrow your way out of this issue, especially when consumers and businesses are already loaned up so much. Well, what happens when you can't pay your rent, you can't pay your student loans, credit conditions are tightening? Well, homelessness rises. According to U.S. Department of Housing and Urban Development, homelessness in the U.S. has risen to record levels in 2023. Record levels, even higher in 2007. Think about what happened in 2007. You had the crash of the economy. You had the Lehman issue, or leading up to the Lehman issue. It was the mortgage crisis leading up to Lehman in 2008, 2009. And a lot of homeless. Well, now it's increased over 12% to 653,000 people, the highest on record. And that's an 8-year change from the lowest figure on record of 550,000 in 2016. So we had a lot during the last recession, which makes sense, but it actually came down to 2015 after the mortgage crisis. People were still able to afford to live, whether it be renting or buying homes or whatever the case may be. Now we're at the highest on record. Why? Well, when you have a situation when rent is high and people can't afford it, and the interest rates are up and housing prices are up and they can't afford it, they can't pay their student loans, credit conditions are getting worse, where do people go? They go homeless. And so homelessness is surging right now in the United States. And it's really no surprise to me whatsoever this is happening. Real quickly, I want to change and talk about what's going on in the Middle East. That's getting worse, as I've been predicting, regardless of what side you're on. If you're on a side or the pro-Israel Hamas, I'm not even going to get into that. The one thing I said that was going to happen is this is going to escalate. It's going to escalate. And I wrote a blog a couple of months ago talking about my experience in college and how this was predicted. This area of the region, along with Eastern Europe, were going to be the areas in which people at the military college thought would, within a certain amount of time, about 10 years or so, would be the big problem areas. And look at what's happening. U.S. Navy assets are converging on Yemen. Why? Because Houthi rebels were shooting at commercial ships and a U.S. destroyer from Yemen. And so now we're going into Yemen. See, it's not just the Gaza Strip. Now we're talking about Yemen. Well, where does it go from Yemen? Does it go to Iraq? Does it go to Iran? Does it go somewhere else? This thing is going to keep getting worse. And you can see that we've got the Bataan Amphibious Group, the Ike Carrier Strike Group, other ships nearby. Over 20 attacks on vessels by Houthis in Yemen are being attributed to the Houthis in Yemen. And what is that going to do to our spend? It's going to get worse. What debt is going to get worse as a result of this? The U.S. debt, 34 trillion now. What's it going to be after we strike up all these wars in the Middle East? And the Fed right now, here's a chart from CNBC about the federal funds target rate. Right now, we're sitting at 5.25 to 5.5, second highest on since the 2000s. And they're talking about possibly cutting next year. Well, how the hell are you going to cut when the economy is crashing and when you're about to go to another war and just spend all this money? How many trillions are we going to spend on this war? Yet another war. How much do we spend in Ukraine? How much do we spend to help the Israelis with Gaza Strip? How much are we going to spend when we go into Yemen? Are we actually going to be able to cut? We may have to cut, because this is going to lead us straight into a collapse and a recession. The market right now is ebullient. The stock market, Bitcoin, bond rates are coming down. Everybody's ebullient because the Fed has signaled that they may cut 3 times next year. And that started to get walked back last week when one of the Federal Reserve board members is saying, well, we'd actually say we're going to cut 3 times. And I read one analysis that said they thought that the market was expecting 6 cuts next year. So stocks up, people are feeling great. Is that what the data tells us? It's not what the data tells us. Give me a break. This is a mess. Pushing the Fed funds rate to its highest in 22 years. That's called a slowdown when credit conditions are tightening and homelessness is going up and people can't pay their student loans. This is a superstorm. This is a massive storm. This is not good. Now moving on to precious metals. We're going to talk about gold and silver here. I'm going to talk about LME. LME plans new metals contracts using Shanghai prices. What have we been saying about Shanghai? Well, if you look at, this is the Shanghai Gold Exchange, and I do this about once a month. I talk about the spread between the equivalent contract between the Shanghai and China and COMEX. The 06 is the June contract. The 12 is the December contract, June 15th and December 15th. The June 15th contract in Asia is trading at $39 over the same contract price on the COMEX in the US. The December of next year, not this year, but next year contract, a year from now, is trading at $90 over on a contract, $90 over spot, over our spot price in COMEX. Because there's more physical delivery. Why is it? There's more physical delivery. There's more demand in Shanghai. It's a higher price. They're giving a more market-oriented price. But the base is COMEX. The ceiling or the floor is COMEX. The ceiling is the Shanghai. Well, now they're talking about the LME, which is owned by a Hong Kong organization, which is a Western entity, even though it's near China and has ties to China. They're talking about that Western-owned LME putting out Shanghai prices. Now, I saw a lot of stuff on Twitter and the news about this. It could be that Shanghai is trying to capitalize on the difference between US and Shanghai gold price, or Western and Eastern gold prices. Some people have speculated that the West is trying to control the Shanghai price, because if you're trading Shanghai prices in a Western market, I mean, what do you do? What do we see on the COMEX all the time? They slam it down with short contracts. So this could be seen as a move of the Western world with this Hong Kong organization that owns the LME to control or to mitigate that difference in price we see here on the contracts in Shanghai, and to control it. In other words, to put a top on it, to control the ceiling. Because the ceiling of gold price right now is not in the West, it's in the East. And that could be one of the motivations. The other motivation is, and this is owned by the Hong Kong Exchanges and Clearing, the LME. The other side of the token may be that the Chinese, because settlement in Shanghai is a little bit harder, more laborious than it is in the I guess, more advanced London markets and US markets, is that China wants a little bit more liquidity in their system. So China may be willing to allow this to increase their gold liquidity in their market, because they expect that trades are going to increase. So think about what I talked about in Silver Symposium a couple of years ago. I talked about, it was JP Morgan, which was helping the Shanghai Gold Exchange in China modernize their commodities markets. And they already carry a lot of commodities, but they're increasing the amount of commodities, and they want to increase liquidity. So this may be one way to increase liquidity of the Shanghai gold contracts, bringing it into the Western market through Hong Kong. Hong Kong's a natural place to do that. Hong Kong is part of the Asian world, but it's considered a Western market. So the China may be trading some of this price difference in gold for liquidity. Well, why would they want more liquidity and to exchange any amount of price arbitrage, allow price arbitrage, allow the West to bring that ceiling price down for gold across the world markets? Because they expect gold market to go bonkers, and they need to get access to the Western market from the derivatives perspective, because they already got a lot of gold, but at one point they're going to want to sell it to finance what? Trade, expansion, to help alleviate problems in their economy, a gold-backed currency. I think that's what's happening. I think they're allowing the LME to do this, to trade the Shanghai contracts, because China expects gold to be money again. It's going to back its central bank digital currency, and it's yuan, it's paper and it's digital, and they need access to the Western markets, and they feel more comfortable doing that through Hong Kong, whereas the Western banks are probably looking at it going, oh, we're going to make a bunch of money. We're going to bring the gold price down. We're going to have it trade in a range, and we're going to make money off that arbitrage, trading the difference in prices in the markets. It's kind of a win-win for everybody. Now, will the West control Shanghai's gold price and really bring this number down? Or will China, because it has a stronger currency and trade unions with more people in the world, actually bring the Western gold price up? That'll be an interesting thing to see over the next several years and how that plays out. How does this, I would say, uneasy marriage between the Western and Eastern gold markets play out? Who wins? I'm putting my money on China. because I think they're going to have the stronger currency going forward, even though they have economic issues. I think they're going to have the stronger currency going forward in terms of central bank digital currency, and they certainly have the better trade networks. That's why their currency will be stronger and their debt ratings will be stronger. Plus, I think the dollar is going to collapse down. So you're going to see the dollar collapse down, not be the world reserve currency, be another of a, still first tier, but probably, tier 1A currencies, maybe even tier 2 if it gets really bad and we have a debt default or hyperinflation. And you're going to see China elevating. So I think they're taking this risk right now. All right, on to the gold and silver futures. The gold price is rising. As of right now, our gold price is in the 2040 range. The time I'm doing this, silver is at $24. Gold's at about 2040, somewhere in that range. It's been up. You can see on the trades, there's been a lot of EFPs. So looking at data as of this morning, as of 9 a.m. this morning, 2,841 EFPs. What is that? It's when, we talked about the difference between China and U.S. gold price, or there's a difference between China and the U.K. And so EFP is basically somebody taking a futures contract in COMEX, a future position, saying, I'm betting on the future price up or down, and I exchange that for a now position in the over-the-counter OTC market in London, which either will get me money on the price difference, price arbitrage, because the gold price may be higher in London or lower a little bit, or it may be to get the actual physical. So you're seeing a lot of EFP action. You're seeing people roll out of February contract and already start to build up April and June contracts. So they're rolling. But overall, the price has gone up, and you can see we've had a nice bit of trade here, and it's been positive. Usually when you see these big days, it's a slam down. It's a bunch of short paper. So we've had a nice little increase from that slam down we had at the beginning of the month. We've had a nice little increase in gold starting to move back up. We're going to see it in the COT report, who's allowing that to happen. And as you might have guessed, it's the bullion banks, but we'll show you that. Going over to the ETFs, we're looking at GLD, SPDR gold shares. GLD is the major gold ETF, which we'll show you here in a moment when we look at this chart from Gold Charts R Us. But getting back to the GLD, you saw really good inflows into the GLD in terms of money. And of course, they're saying they're backing up with physical, even though you can't redeem it as a shareholder. They still have to have some physical. Most of this is held in London. But then it kind of tapered off for a while, but we've had some nice spikes here in mid-December. So people are starting to get back into GLD. I think they're seeing geopolitical risk, especially. They're seeing some inflation start to tick back up. And you notice when the geopolitical problem started and inflation started ticking back up in the CPI, even a little bit, flows go into what? GLD, gold. Why? Because it's exposure to the gold price. That's what happens. It does not surprise me at all. Moving over, we're starting to see more ounces to the tune between the UK markets and the US markets. We're seeing 315,000 ounces of gold come on in the last 4 weeks. So the last 4 weeks, you've seen a ton of gold come onto COMEX, and you've seen some come into the international markets as well, although some funds have lost money. Xetra Gold has lost gold ounces. That ETF, iShares CGL TO has lost. Some of these have lost some. Deutsche Bank's XAD5, gained some, but net, there's been a lot flowing in to the gold coffers. Now, overall, if you look on the chart, total all ounce held, it's only been this little baby blip. So don't think that we're just flush with a bunch of new gold. But what happens when gold price, when geopolitical and inflationary events and debt events cause people to go to safety, you see an uptick. So this is a baby uptick. This is before the big run of gold. We're not the big run in gold yet, where everybody wants it. And all the ounces come out and it starts trading for real. But you're starting to see a little bit of uptick. Why? Because geopolitical issues, uncertainty with the market, inflation starting to tick up in the US again. Moving over to silver, if we want to look at volume and OI, we've had some nice volume trade here in the middle of December. Price has been rising. Notice these are the slam downs. These are the price rising. That's how it works. Now, the key thing there is it only takes a couple of days of moderate long interest or bullish interest in gold to bring that price back up. But it takes big slam downs to bring it down. That's what tells you is that the slam downs have to be so much more abrupt and so much more obvious and blatant to bring the price down that overall net people want gold price to rise. That's why I'm not worried about gold price in the medium term. I'm just not. In the next few days, could it come back down to 19? Sure. But there's more long interest than short. That's why they have to hit it with so much short paper to bring it down, because the overall long interest, there's more longs in the world than there are shorts. Now, the longs haven't come in just with a strong hammer yet. But as you see us heading more to recession, that's what's going to happen. Looking at the 9 a.m. data for today, 375 VIPs, nothing that's become about. A lot of volume though, 44,000 contracts is really good. We'll move over into settlement data, and gold, as of right now, is up about 21 cents on the day for the dominant contract in February. Actually, most of the volume now has moved to March. I apologize. That's February for gold. For silver, it's March. And I keep saying gold, it's silver. So it's moved up 21 cents on the day. That's Tuesday's data. Monday, it was down about 50 cents. And overall, it's doing pretty darn. Okay, so continuing on silver, what we're seeing in the silver market is fair amount of demand over on the derivative markets. It's not a frothy market. It's not particularly strong either direction. We're going to see that the bullion banks have released a lot of their shorts. They took a bunch of shorts, by the way, to keep silver contained and not go above 25-ish or so. Just like they did gold as it got near, or as it exploded past its all-time high. There's been a ton of shorting in both. The bullion banks are releasing some of that short pressure because they can't hold it forever because it costs them money to do so. They need to short cover and sell that out, so they need, to let the price move. But overall, silver is not moving a lot right now. Retail demand, however, is ticking up, and I'll show you that here in a minute when we get into the iShares data on SLB. But overall, silver's down a little bit at the end of last week. Gold and silver both were down. So this is typical on Fridays. They'll close down. It'll race right there. We can close down, race right there. We can close down. It keeps momentum from heading from the American market over to the Eastern market. China in particular, so this is done on the Western markets almost every week. And we see that same pattern. I just show it every week so you guys see it. Moving over to the SLV, we saw the GLD, which was the gold ETF fund. Now we're seeing the SLV. A lot of demand here in the SLV. So retail is now starting to get more interested in SLV. Typically, retailers that buy SLV are new to the silver market. They don't buy the physical ounces, but we see a lot of this transmute into physical demand once people figure out that they're not going to be able to get the physical out of there. And they're like, wait, I need to hold some in my hand. So people will start in SLV, and then they'll eventually migrate over to silver, go to local coin dealers, stuff like that. And so we've had, just a couple of updates in silver, but they've been strong updates. And you can see it happen in about the middle of each month. People came in and demanded, and that has to do with the news, because there are big news events around those days, and people are buying the retail. It does not surprise me at all. And I think overall going forward, I think silver demand, retail demand is going to go up quite a bit. Even though the prices are played around with a lot on the derivative markets, people are buying silver anyway. It's poor man's gold. It's what people can afford. All right. I promised you we'd look at the COT report. This is a commitment of traders report from the CFTC. This is through December 12th, 2023. Remember, it's always about a week in arrears. We'll get the updated one a couple of days later this week, maybe Friday. They don't always put it out on the exact same day. But this is the latest one as of today. You can see I'm right off the website here. You can see in silver, this is silver. You can see that the bullion banks, or the swamp dealers, released 5,000 shorts. They dropped 5,000 shorts. So at some point they were at 48,000 and about 715, 16 contracts. So they dropped 5,000 in a week. So they were almost net even. So they were about 32 here and they were about 33 here. So within the last couple of weeks, they've added 10,000 short contracts to keep that price from rising too far above 25 bucks. Remember, and gold popped and silver started to follow. So in 2 weeks, they just hammered silver down. And they've started to release a little bit of that pressure to the tune of about 14, 15,000 contracts. And they started to relieve a little bit of that pressure. They backtrack 5,000. They have to do that so they don't lose their shirt in the futures market. They got to roll those contracts to another month. They've got a short cover. They got to do a lot of things. That's why they can't do this forever. There is a cost to it. But with the money they're making on their options trades, they can use futures to move around options target. They'll make money on options and cover some of their losses in the futures trade, if you're ever wondering how that works. And that's why a couple of analysts, only a few, cover the options on a daily basis. Craig Hemke being one of those. Follow his Twitter feed. He covers the options a lot, and he points this out. Options makes money and covers for a lot of future. If you're wondering how they can do this and cover a lot of their hammering down of the silver and gold price and futures, a lot of it has to do with options, but a lot of it has to do with positioning and timing. A lot of it has to do, they're exposed to multiple markets as well. You did see some reduction of shorts by the producer merchants, but mostly it was by the banks, and then the managed money took the other side of both of those positions. They dropped 10,000 longs. They're still net long. The financial houses are pension funds. of silver. They probably need to be more net long, but with the recent fade in silver price, it doesn't surprise me if they drop some longs, take the other side of that trade. That's how you basically cover your shorts. Bullion banks do it all the time. In the gold market, same thing. We see the managed money drop a bunch of longs to cover the bunch of shorts that were just dropped by the swap dealers. That's why the price is rising. The swamp dealers or the bullion banks allow that price to rise by dropping some of their shorts. They got covered by the managed money who took some of that hit as the price is rising. And they make some money on the options trade to cover that. And that's why the price has been rising, is because last week's data and probably this week's data, since gold and silver price are up, is going to show that it's the bullion banks releasing that pressure valve. But they already did their job. They already stopped the price from rising. They stopped gold from getting too frothy. When you had that Sunday night open a couple of weeks ago of gold and exploded up 58 bucks, I had to hammer it down and silver at the same time. And now they can release that pressure a little bit at a time over the next couple of weeks. So even next week's COT report, I expect to see a little bit more reduction in shorts in both gold and silver by the bullion banks. Moving over to the silver ETF chart, same chart as we had in gold. What you'll see here, however, is the physical trade starting to get interesting. 5,000, almost 6,000 ounces have been added to the UK and the US markets. Net overall, there's been a lot of registered silver move. That's for delivery. Eligible has been decremented by 6 million ounces, but an additional went into moving and delivery. 6 million of that came from eligible. So a net move of 2 million ounces back into COMEX. Now, if you look at the chart, that doesn't really move the needle of the overall silver ounces held across the world. So it's a little baby move, but it shows up big on a 4-week chart because it's against the trend. Overall, across both markets, the two Western markets, you've had almost 6 million ounces come into those markets. Again, that's nothing compared to what's been run off the last couple of 3 years, almost 3 years now, since silver squeeze. But they're putting more back in because they have to, because why? There's physical demand for both gold and silver. That's why the gold and silver is coming in. They're trying to keep it liquid enough to where those markets don't seize because there's not enough metal for the demand. They're putting enough in just to cover the metal demanded to keep those moving. But again, going back to the Chinese markets, they're trading much higher. That tells you what worldwide demand is. The fact that the June contract's 40 bucks higher than COMEX and the December of next year is $88 higher is telling you there's demand. And so they had to bleed gold and silver back in. Eventually, they're going to run out of stock. And it's flowing from west to east. That's how you follow that. Follow the prices and follow the physical trade and the derivative trade, and that's how you know. So that is essentially what's happening in silver. So that basically is your gold and silver report. The one market in which silver had flowed into the most was the Swiss, the ZSIL. That ETF got the most silver. And I wonder who's depositing that silver. Is it the Chinese? It says somebody in Europe. Who is that? I found that to be interesting. But in any case, you can see what's happening. The Western derivative markets are keeping the price tamped down. The East is sucking up that metal and taking it in, saying, thank you very much. You can see by the contract prices. China now has enough gold and silver. They're allowing the LME based in Hong Kong to start trading against the Shanghai gold price, because they think the upside of that liquidity they're going to get, because they're going to use it to back their currency, to back their system as they go into recession, is worth the potential control that the West thinks that they're going to get over it. However, I think China will win there, because what wins in these markets is access to commodities and trade, and China has better access to commodities and trade than the U.S. does right now. And they have more gold than the U.S. does right now. I think they have over 20,000 tons. There's no question. And I think the U.S. probably has much less than 8,000 tons, they say, is stored in the U.S. because they haven't had an audit in nearly 70 years. And so I think China knows that, and they have the stronger actual physical position. So they're going to allow, Western access to those markets, but they're going to allow it on the derivative side, not on the physical side. I don't think they're going to bleed a lot of physical. And I think they want that liquidity, though. They want access to that market. And I think that benefits the Chinese quite a bit. And I think it's a smart move by them. And, that's basically what's going on right now. The economic data is not good. We have the euphoria of the holiday season. It's going to wear off. 2024 is going to be extremely volatile from a price perspective, inflation, interest rates, prices you pay for things. Stock markets are going to start having violent $200, $300, $400 or 300, 400, 500 point days. The gold market, we've already seen $130 down move, slam down. You're going to see that on the top side when gold gets to 22, 2300. You're going to see it move $100 up. You're going to see silver move $4, $5, $6 up in a day. You're going to see a lot of that kind of stuff occur, and it's going to be a lot of violence either way in those markets in 2024. So in any case, to wrap up the video, I think 2024 is going to be a very volatile year. I think interest in precious metals is going to come back big time. I think because of all the issues in the economy, geopolitically, what's going on, expanding war, bigger credit issues, China having more gold, Russia having more gold, backing their currency with gold, onset of the central bank digital currencies. A reminder for Thursday's video, I'm going to go over the second part of the central bank digital currency series. You don't want to miss it. The first part, as I mentioned before, is more academic, whereas the second piece is going to be a little bit of academic and review from the first piece for those that didn't catch it. If you can, go catch last Thursday's video. But I'm also going to talk about what the system is going to look like from a practical perspective and why they're doing it. Why they're doing it is the most important part of it. And then in 2024, some subsequent videos, I'll cover individual pieces of central bank digital currencies and what they'll look like. But they're building a new system. I'm going to tell you what that new system is Thursday. Please, please do not miss it. Whether you're in Bitcoin or gold and silver, or you're just getting into this and you're not sure, you need to see those two videos of the two most important ones I've done today. All right, back for the final segment. We're going to get this video done and posted today. I promise, guys. We have a lot of good business coming to the store. This is our sale for the week. I'm going to debut it this Tuesday because last week I didn't run one, and we're going to do gold. So I'm going to put my gold Krugerrands. I have a limited edition of these 1 ounce gold Krugerrand, backdated, just meaning they're not 2023s, but they're legitimate, all been tested, all good. A lot of 70s and 80s stuff. Krugerrands on sale for $2,075. That's right, $2,075. That's lower than any of the major online outlets right now. Gold is trading between $20.40 and $20.50 today. This is a really good price. This is between 20 and 30 bucks over spot for the most well-known and the oldest gold sovereign coin, the Krugerrand. That's right. It's going to trade today at, I'm going to sell it today at $2,075 per ounce. $2,075. If you guys order these, you can go on. What you'll have to do, I'm sorry, let me explain this. To get that price, don't go to the portal and buy it, for the store price. What you want to do, and let's go ahead and present screen here real quick, and I'll walk you through how to do this, is you want to go to our website, www.goldsilverpros. Make sure you put the www.goldsilverpros.com. You want to come over here to discounts. Don't go to the metals and go to gold coins and buy it there because it's the full price. I'm giving you a discount special deal. So whenever I give these discount special deals, click on discounts. And it's cheaper even probably than I have listed here. It is by about $3. You click access discounts here. You fill out this form. I'll call you or email you. We'll settle the deal at $2,075 on that form. And I will get you an invoice mailed over so that you can pay for that. And we'll get this shipped out to you. $2,075 per ounce. Should be free shipping unless you live in a weird place and it's very expensive. $2,075 an ounce for gold Krugerrand, and I'll quote you a full price, including any shipping. Some places a little bit more expensive than others, but we'll get that out to you. This is a really good price. It's going to beat any of the major online retailers right now. And I love these coins. Would love for you to have them. Gold Krugerrands are the oldest, most recognized gold coin in the world, and they're lower premium. I'm giving it to you basically at wholesale price. That's what it would cost me if I bought it from my wholesaler today, $20.75. So you're getting wholesale price on 1 ounce gold. While supplies last. I don't have that many. I'm not in the double digits on these. This is less than 10. Okay, so I'll sell those to as many people as I can. Killer deal, wholesale price right now. I think, given what's going to happen in 2024, that's a killer deal on gold right there. Period. I don't know if you can get an ounce of gold cheaper than I'm offering it to you right now, especially the most recognized coin on the market. All right, thanks, guys. Till next time, Rob Kientz, www.goldsilverpros.com.